All right, let's dive into a really critical, and I mean critical, part of the new Income Tax Act 2025. We're talking about Section 25 and this whole concept of the deemed owner. If you're a tax professional, this is one of those things you absolutely have to get right.
So let's kick things off with a scenario you've probably seen 100 times. You buy a property, but for whatever reason, you register it in your spouse's name. It starts generating rental income. The big question is, who's on the hook for the tax? You or your spouse? Well, the answer isn't as simple as just looking at the name on the title deed.
And this right here is what we can call the ownership puzzle. It's a situation that pops up all the time. And you know what? It's often a deliberate part of a family's financial planning. You know the drill. The strategy is usually pretty straightforward: tax planning. The idea is to transfer an asset that makes money, like a rental property, to a family member who's in a lower tax bracket. The goal? To lower the family's total tax bill. But, and this is a big but, this is exactly the kind of arrangement that gets the tax department's attention. So how does the new tax law deal with this? Well, the answer lies in a very specific, very targeted provision. Let's unveil Section 25. Make no mistake, the new act tackles this head-on. Section 25 is designed to be a powerful anti-avoidance measure. It basically gives the tax authorities the power to look right past the name on the paperwork and find out who is truly benefiting from the income. This is all about making sure the tax liability lands in the right place and preventing these kinds of transfers from being used to just sidestep taxes. At the absolute heart of Section 25 is this concept, the deemed owner. What it means is that the law can treat someone as the owner for tax purposes, even when their name is nowhere to be found on the property documents. The key takeaway for you as a professional is this. For the tax authorities, beneficial ownership can and often does trump legal ownership. You know, this really highlights the entire philosophy of the new 2025 Act. As the official FAQs point out, one of the main goals is to simplify the language and cut down on all the ambiguity. And Section 25 does exactly that. It provides a clear, straightforward rule for what used to be a very common area for tax disputes. Okay, so now let's get into the nitty-gritty of the law itself. We're going to do a clause-by-clause breakdown of deemed ownership. So Section 25 is built around two main circumstances. First up, we have Clause A, which covers transfers to a spouse or a minor child. Honestly, this is the one you're going to encounter most of the time. Then you have Clause B, which is a bit more specialized. It deals with something called an impartible estate. We're going to examine both. All right, let's do a deep dive into Clause A. Think of this as your mental checklist. The rule applies if an individual transfers property to their spouse or minor child. And here's the most critical part. It has to be a transfer made without adequate consideration. But there are a couple of key exceptions to watch out for. It doesn't apply to transfers made to a spouse as part of an agreement to live apart, and it also doesn't apply to a minor married daughter. Oh, and it's good to remember that the definition of child here is broad. It covers a stepchild and an adopted child as well. Now for Clause B. It's definitely less common, but still important to know. This one applies to what's called an impartible estate. So what's that? Well, think of it as an ancestral property that, either by law or by tradition, simply cannot be divided up. In these very specific cases, the law says that whoever is the current holder of that estate is deemed to be the individual owner of all the properties within it for tax purposes. Okay, theory is one thing, but nothing makes it clearer than a practical example. Let's put Section 25 into practice and see what the actual tax impact looks like. Okay, let's walk through it. Step 1. Mr. Verma buys a flat. Step 2, he registers it in his wife's name, and for our example, let's say she's not working and it's for nil consideration. In other words, it's a gift. Step 3, the flat starts generating a nice 6 lakhs in rental income every year. So Step 4, what's the tax consequence? Because this was a transfer to a spouse without adequate consideration, Section 25A is triggered. The result? Mr. Verma is now the deemed owner. That entire 6 lakhs of rent gets added right back into his income, not his wife's. So, as professionals who are advising clients on these things, what are the key compliance points? And, maybe more importantly, what are the common mistakes we need to watch out for? So much of this provision boils down to one critical phrase: adequate consideration. But what does that actually mean in the eyes of the law? It's actually quite simple. It means the price paid for the property has to be equivalent to its fair market value. A token amount, a gift, or a transfer made simply for love and affection, none of that is going to qualify. The law is looking for a genuine arm's-length sale at a fair price.
So here are the big pitfalls you need to help your clients avoid. The number one mistake is confusing the legal title with tax ownership. They are not always the same thing. Another huge one is failing to properly document proof of adequate consideration. If you can't prove it, it didn't happen. You also have to consider the other clubbing provisions when advising on these transfers. And finally, don't forget, this isn't just about spouses. It applies to minor children too. It's crucial to be clear with clients that these rules are here for a reason, to shut down these exact arrangements. All right, to wrap all this up, let's go over a final checklist. These are the key takeaways you really need to have handy in your practice. So, what do you really need to remember? First, ownership for tax can be completely different from legal title. That means you should always investigate the source of the funds used for the purchase. Second, remember what Section 25 is. It's an anti-avoidance rule. Advise your clients accordingly. Any plan designed solely to shift income is likely going to fall under this. Third, adequate consideration is the key that unlocks the exception, so you have to ensure transfers are genuine and documented at fair market value. And finally, the person who made the transfer remains the deemed owner, which means the income has to be included in their tax return. Keep this checklist in mind, and you'll navigate Section 25 with confidence. And that's our look at Section 25. Thank you so much for watching. If you found this explainer helpful for you and your practice, please go ahead and like, subscribe, and share it with your colleagues. And of course, the disclaimer, this video is for educational purposes only and does not constitute professional advice. Tax laws are always subject to amendments, so please be sure to consult your professional advisor before taking any action. This is an AI-generated educational video.